Good morning, everybody. Welcome to the Flow Show. Here we are, Friday, NFP day, the big one, the biggest data point since the last biggest data point, and no doubt the smallest since the next biggest data point to come next month. Morning, Kay. Locked and loaded.
Good morning, Ryan. Good morning, everybody. Is it weekend yet?
Nearly.
Yeah, we're always ready, aren't we? Yes, this is going to be a big one, and especially that we have two interesting speakers also after the numbers, which is going to spice up things a little bit if we would have a report which doesn't give the market too much of a direction.
Yeah, we got Waller and Williams later on, who are a couple of the big wigs. Waller particularly because he's on the board of governors. He doesn't speak that often, and when he does, he can be market moving. But I think in this current scenario where we know the Fed are going to be cutting in September, the question is not whether they agree with that, but the market's going to be looking for what side of the fence they're on the 25-50 basis point cut fence. But it's likely that they're not going to really pick a side. They might pick a side. One or both might say that, it's no reason to do a big cut right now. But if they follow Powell, excuse me, they'll keep that optionality on the table, I think, Kay.
Yeah, exactly. Also what we had to note is that over the past months, the divergence between hawks and doves has been reduced, right? This seems to be some kind of accord within the FOMC or the Fed globally to say that we have to speak one word because of perhaps they are a little worried that if they would decenter too much, the market would go into a bit of an irrational or too volatile picture. So there seems to be some kind of deal or accord between them to say like, okay, we are going to keep things as smooth as possible. Yeah.
Yeah, exactly. And keeping or not shutting the door on a 50 pip hike. It's much the same as when they were talking hawkish with rates going up and trying to combat inflation. Just having hints of something like that does half the job for them because it gets the market easing financial conditions. Remember, we talked a lot about tightening financial conditions just on what they would say rather than what they would do on the way up. Well, they're going to do the same on the way down. Keeping a 50 on the table helps ease financial conditions without them actually having to lift a finger. So it's just, again, the way these central banks play the markets and play the economy and whatnot. Doesn't mean they're going to do a 50, but talking about it does, as I say, does the job for them sometimes as well. But anyway, we'll get into that a bit later too. Just to get you in the loop, if you haven't already, I've just put the link in the Zoom chat there. Our NFP competition is open. Great prizes on offer again this month for 3 winners. First prize will get a free 30-minute coaching session with one of the team. Also 30 days access to the ForexAnalytix platform, a month free access to Live Squawk, and a free annual premium subscription to Peak Suite as well. And then the next 2 winners get pretty much all that, less time on Live Squawk, no coaching session, but still some decent prices there. So don't forget to enter the competition. Only guesses in that tweet will count. Click on the blog post in that tweet as well, just to see all the full rules and the prizes on offer. And we're going to look over the months ahead to get some even bigger prizes and more prizes added to that too. So get involved, boys and girls. You know the link. Put your guesses in. You won't beat me. 333. That's my guess. What have you gone this time, Kay? Not for your usual 111.
No, I went for 234. It's a bit of a different number. Yeah, just because there may be some revisions of the revisions and some accounting stuff going on. and to keep it all a bit spicy, you know, if we get a better number, it's going to make things very interesting how the market will react on the back of it, right?
Yeah, exactly. We'll get stuck into those expectations as well in a little bit. Right, let's get through some of the headlines and data points just to bring everyone up to speed and give our thoughts on. Over in China, they're fixing down their reference rate. We're into the 709s and staying in the 709s, so they're happy to let the yuan strengthen a bit more rather than on the other side where they kept fixing things fairly low when the market was looking fairly high. So they're still happy to let things go. There's not been too much chatter out of China about the exchange rate. Well, virtually none at all, really. Maybe a case that it's brewing. As we said yesterday, myself and the K-Meister keeping our BDI on this one. If it gets down to the 7 handle, that may bring around some few comments from the PBOC or officials. But for now, they're happy to keep letting yuan strengthen. Over in Japan, had a little bit of data out, some household spending data out. And just make sure it's on this calendar. There we go. Coming in at down 1.7% for July and a measly 0.1% year on year for that number. So not such good news for the government. They would hope that all these wage rises would mean that consumers open up their purses and get spending a bit more. But it seems that's not the case at the moment. So that's one area that they may have a little bit of concern about, may fall into the BOJ's thinking regarding rates. Over in Germany, we've had a little bit of mixed news, shall we say. There's been a bit of activity on the trade front. We got imports up 5.4%, exports up 1.7% as well. Means a worse trade balance, but activity has picked up. We've got some industrial production numbers as well, which showed a big hefty negative, which goes against what we've seen from the recent factory orders numbers as well. But it takes a bit of time for orders to turn into production, and there's different sectors involved in production as well, but not good numbers. Anyway, we also got similar numbers from, who was it, France, coming in negative as well on the month, down 0.5% for their industrial production as well. And activity, exports a little bit softer on their trade balance as well. Imports a little bit softer as well. So a bit of a dip in activity there too. Final GDP numbers for Q2, not that it makes much difference anyway, but it came in softer in the Eurozone. Couldn't even meet the flash and prior number, 0.3%. So another ground bumping 0.2% there. Not exactly hike numbers coming from those guys. Going back to yesterday's data, and a lot of job stuff out yesterday. It all kicked off with the Challenger layoffs number, which came in a quite chunky, just under 76,000. Challenger. That number in itself, it's not that high a number. We've had higher over the recent months, as you can see. Go back a few months, we've had 60s, 90s, 84s, 82s. So it's not a huge number. There's always attrition in jobs. You've got to remember that people get laid off, people get hired every day. But what we look for is when that ratio tips one way or another. But at the moment, that's just a bit of attrition. But we'll keep an eye on it. A comment that Challenger Gray did say was that hiring has fallen to its lowest year to date since they began tracking the numbers in 2005. So yet again, another piece of evidence to say that hiring is slowing, not going backwards, but slowing. And so we've seen that pretty much in all the data points as well. ADP, that came in a little bit of a miss, 99,000, as you can see there. The prior was revised down as well. They did a similar benchmark revision to the NFP that got everyone hot under the collar last week. Their revision was only 9,000 off of that number. So if that hadn't been revised, that number would have been 108,000. But the trend is your friend, and we're just seeing these gains creeping lower. Initial jobless claims, nothing to write home about. Same old, same old. Still seeing, 200, 230s, 240s, that sort of area. 1.8 million for the continued claims. No change, as you can see. 4-week average, very barely changed there. So nothing flagging from this series that says there's anything going on in the jobs market. Q2 unit labour costs. This was a final number, much softer than expected. The Fed will be looking at that one closely because it falls into the wages side of things. So that was down, one could say, nicely for them. Productivity was up, higher than prior. So again, good work over there. Soft landing data still coming from that. Then we got into the PMIs. We had Canada S&P Global coming in their final number 47.8 versus 47.3, so a bit of an improvement there. The S&P number came in higher as well, 55.7 versus last month's 55. Sorry, the flash 55.2. And where is it on there? Am I losing it? There we go, in there, and the prior 55. So an improvement there in the services number. ISM, that was the big one. That showed an improvement, 51.5 over expectations and last month. New orders looking good as well. Employment missed expectations, came in lower, but still held into expansion, which I think was the important point from that it didn't go into contraction on that one there. So again, not seeing any big falls in any of this data, although the report said that employment had fallen for the first time in 3 months, and they saw the slowest. Sorry, this was for the S&P. The employment fell for the first time in 3 months and saw the slowest pace of output price inflation since January. So output prices not gaining as much, but they continue to report sharp increases in input prices. The ISM was pretty much the same as we got from the manufacturing ISM in terms of the respondent comments. Some are happy, some are not. Some are seeing a slowdown on the consumer side. Any takeaways really from that lot of data, Kay?
No, just that we have to be cautious not to go overly bearish or dollars or trying to guess for 50 BPs before the numbers really tell us that we're going to get there. So sends us over to today, makes today even more important, I guess. And yeah, I mean, it's not all that bad over in the US, right? No, for the rest, nothing really special to take away from it.
No, exactly that. We mentioned Wallow and Williams, who are going to be up squawking today. We had Fed Goolsbee out this morning. He said trending economic data justifies multiple rate cuts starting soon. So he's a bit of a wild horse, is old Goolsbee, in some of his comments. So he's looking at multiple rate cuts. I guess we'll get to see whether he's going for 50s or whatnot. Over at the ECB, there's been a poll out, Reuters poll out, with economists expecting the ECB to cut rates in September and December. No real change from the August poll. 64 out of 77 economists expect 7 debt cuts versus 66 out of 81 in the last poll. So no real change there. Treasury Secretary Yellen said a good, strong jobs market is being seen and growth continues at a rapid pace. Says the labour market has become less tight but continues to create jobs. That's waffling with a political hat on, of course. Something to keep an eye on for a few things, for GDP, for inflation. There's a potential port union strike going to be happening in the US, which has the potential to shut down quite a few ports. I put this story in our newsroom yesterday. It's something like if they strike for a couple of days, it will cause 1 week's worth of disruption. If they strike for a week, it will cause, you know, maybe a couple of months worth of disruption. You'll remember what disruption we got over COVID and whatnot, and other things where ships couldn't get into ports and travel and whatever. So if there is a big prolonged strike over there, it will impact activity. And it will impact prices, and that's something that no doubt will get the Fed squawking about in speeches and whatnot, but just one to keep an eye on if that happens. Over in Canada, we had this political stuff going on with this coalition partner pulling out of Trudeau's government. Their leader, NDP leader, says an election is now more likely than before. So it seems like they're going to be pushing for an early election, whereas Trudeau is hoping that one doesn't come until next year. Over in Mexico, the deputy finance minister is talking about some stock market reform that will allow access to financing of up to 70 billion mex a year for small, medium firms. Kay, I don't know if you've got any view on that. But some movements over there in what they're looking at, potentially supportive for the economy and their stock markets at least. Anything you've seen from that lot?
Yeah, it's how should I say it? I saw that and then I was thinking about it, but is it really what it's a bit like how shall I say it's not the same scenario because Bank of Japan doesn't buy ETFs to really help or sponsor companies, but it may be those things are always positive in the short term, and in the longer term we have to be very, very careful about it because it can end up being a bit of a money hole, you know, pouring money into empty holes and never getting filled. So we have to be a bit careful because it can end up being very much of a double-edged sword. Makes me think about when Japan was also to compare it, when Japan was also telling people to go into risky assets, but then was in deep into deflation and the stock markets kept on coming down. I mean, yeah, short-term positive, long-term remains to be seen.
Yeah, exactly that, mate. Right, well, let's move on to the big event today, which is obviously going to be the non-farm payrolls numbers. So we've been talking about our thoughts all week, so we won't dwell too long on those, just give you our final thoughts and whatnot. As usual, you need to know what to watch for and how to read these numbers. So obviously, first and foremost, the headline number 164, 165, depending on what calendar you're looking at. That's the expectation for today's number. So firstly, again, as mentioned, this one could be a bit of a wild one this month because we got all that revision stuff from last week, that 818,000 downward revision. The market will all be thinking that maybe this number, whatever it is overstated. We've also got the storm issue where apparently 250,000 jobs were temporarily put on hold because of the storm and whatnot. People couldn't work, so that might filter in as well. So there's lots of noise around this headline number, hence why we've been saying all week that's probably not the important one item to look at. Okay, the market will move on it, it will react to it, but you need to know what's really going to move the market. And as we've been saying, this unemployment rate is going to be the one to watch. That should be your ultimate guide for these jobs numbers. Okay, so if that comes in because there's 250 extra jobs added onto that number and comes in at 400,000+, of course it's going to be good. But if that number there ticks up to 4.3, 4.4, or even higher, then that's going to take the market move. So you're going to see a reaction on that. So the unemployment rate for this one is going to be the cleanest number to watch. But as always, you've got to measure that against the participation rate because this participation rate can move the unemployment rate. So if the participation rate goes higher, that means there's more people coming in to look for a job, which means they add on to the unemployment rate. Okay, so you could get this going up to 62.9, 63, and the unemployment rate rising. Now, what would be a real negative is if the unemployment rate goes up as the participation rate goes down. Okay, so that would be a very bad signal. That would say that unemployment is really looking weaker rather than unemployment growing because more people are coming in and looking for a job. So that's going to be the important sum to look at there. Then you can look at wages, which have been coming down. Look for any big variation, really. If it comes in around expectations, a pip here or there, don't worry about it too much. But if we get a big down move in wages, 3.5, 3.3, maybe even less, wages, as we know, is something that the Fed and a lot of central banks are looking at. So that will add to the cut side of things. It won't signal whether it's going to be a 50 or a 25, but it will just play into the fact that the Fed will cement a cut. So that's the way to look at these numbers. Okay, sometimes we look at these numbers for the job impact. Sometimes we look at them for the inflation impact. This time it's all about the jobs impact and that unemployment. I think, Kay, anywhere maybe a pip either side of this, and maybe we won't get too much of a reaction. Of course, if the unemployment rate comes down, then that's going to kibosh all the 50 pippers out there. And we probably see a decent rally. So the price effect from this, I think, is very binary today, mate.
Yeah, very much so. And the reason as well why the employment rate is so important, as Powell has told us that they would support an ailing jobs market for one. So you look at the unemployment rate, and the second reason as well is that famous 4.3% is the top end of their expected range for the unemployment rate, even into 2026, as we've been talking about in our room yesterday, for those who are not in our room. So get a print above 4.3%, even if it's 0, even if it's 4.4, that would be taken as very negative by the market and potentially opening the door then to a 50 BP, sorry, interest rate cut. So it's going to be extremely important that that rate. Now, inversely, sorry, and okay, of course, if we get those revisions, storm impact, whatever, and we get a 4.1 print, the market may initially have to buy some dollars, but then we will have to look at the secondary indicators and perhaps the household survey, which comes out a few minutes after the NFP, if I'm not mistaken. Some people on X are always getting that stuff more quickly than I can look it up. So yeah, that's going to be really what's at play here today, just because of the proximity of the next Fed meeting and all the reasons why. And they have all been changing their rhetoric over the past meetings, over Jackson Hole in Powell's case, but all of them, even the Hawks, are now on board for rate cuts, but they seem to be themselves undecided whether to go for 25 or 50. So far, they hold the gradual line, which would tell us that they are rather in for several 25s than a 50. But if this employment rate jumps above 4.3%, I think that opens the door wide to a potential 50 BPs move.
Yeah, I'm in line with that view, mate. This is going to be important. And also, I think we've got CPI next week as well, so that's going to be another bit of icing on the cake for whatever happens. But as they're going to be cutting on inflation coming down anyway, that's probably now that's the lesser of the numbers we need to watch. As Kay mentioned, Powell's made the jobs market the big deal at the moment, so that's what we need to watch in terms of that. We do also have Canadian data as well, jobs data out, so that's going to be a bit of a sideline to the US numbers this week or this month. So really, if you're trading something like dollar CAD, you really got to look at this data as to whether it kicks that pair out of kilter from the dollar side on what's happening with dollar pairs over NFP. So, for example, if it's a really bad number from the US and you're seeing euro dollar cable jumping higher, but we get a poor one from Canada and dollar CAD jumps higher, that's going to be an opposing move because the dollar's getting sold everywhere else and it's getting bought up here on the back of weaker Canadian dollar. So that may be an opportunity to fade that. But I think this one, the Canadian stuff's going to take a real backseat today to the US data.
Well, I hope for us there are not too many Canadian people listening because they won't agree with you. The thing is, of course, everybody's focusing on the bigger market by volume and by importance. It is going to be interesting though, for several reasons as well. First of all, that it comes on the back of the Bank of Canada rate cut. If we get an additional weak print in the report, and just for new viewers, you look at the report, you look at the headline number, you look at the employment rate, and then you look at the balance between full and part-time employment, which is usually the one that is that could make a move viable or counter it in some way if the numbers are not too far away from expectations. But as I said, it comes on the back of the Bank of Canada, so I wouldn't dismiss it. Personally, I'm going to stay unless I see something really strange in there, and then in combo with the US report. Dollar CAD, I'm not inclined to trade too much dollar CAD, but I've got like very small positions in CAD crosses. I think CAD crosses could be interesting to trade over the Canadian jobs rather than dollar CAD, who could be so to speak, a big figure away on the release of that combination. If the one is going good and the other one is really bad, there won't be even time to trade it, I reckon. So yeah, I think it's going to be, for me at least, more interesting to trade crosses on the back of the Canadian report than dollar CAD as such.
Yep, very much so, mate. And as you can see there, Williams is speaking 15 minutes after all that data comes out, particularly the US data. So if he does have something big to say, you need to switch your attention to that as well. Waller's not speaking until later on in the afternoon. So that will probably be the last hurrah of the weekend, and then we'll all pack up. Well, we will. All the Yanks will still be there till the end.
Brian, yes, it does seem like globally speaking that Waller, even though Williams is a very important guy at the Fed, but it does seem that Waller has been kind of talking along Powell's line a lot. He has changed from being a very hawkish guy past years to aligning himself a lot more with Powell. So we were talking about in the chat room, as you know, it appears to me that he perhaps rather than Williams, maybe Powell's voice this afternoon, if there is something really specific to take away from the jobs data. Yeah, what do you think?
Yeah, no, I agree with that. I agree with that. Yes, it's good. Waller, as I say, he doesn't speak that often. You know, we get some of them like your cash and carries and your Goolsbys who are up every 5 minutes when they feel like it. But Waller doesn't tend to speak. As far as I can see, last time he spoke was 17th of July when he said that they're getting closer to cutting rates, but are not there yet. And that was the same as what Williams said at the same time. The last time Waller spoke was on payments and some other crap on the 28th of August. So he doesn't speak a lot. And as we've said, when he does speak, he can say something that does move markets. But to what degree, or whether he does, we'll have to wait and see. But yeah, definitely Waller's the one to watch. But you know, you always got to listen to what Williams has got to say as well. He's one of the old guard there at the Fed at the moment. Right, so let's have a look at some prices then. And it's really today we've been pretty much building up to it. I've been a bit reluctant to trade because I don't really have conviction of trusting anything that has been going on. but now is the moment to plan and, you know, get your levels set, know where you would like to trade. You don't need to pick a side. You don't need to guess whether the NFP is going to be higher, lower, unemployment higher or lower. There's no need to guess it. Just wait for the numbers. The only place you need to guess is our competition, where you can actually win something and it doesn't cost you a penny. Now, dollar yen, and I want to get your thoughts on this, Kay, because this move in the yen is now looking more than just expectations for data and stuff. You know, we've done over 500 pips top to bottom since Tuesday. Yields are dropping as well, which that might be a bit more tied to the Fed and not exactly to the data, i.e. the market or traders, investors locking in that higher yield ahead of expected cuts. But the size of this move, it's not, we're not just trading the data. Is that going to make this data just a mere little speed hump potentially?
If it's bad, it's going to put a lot of pressure on this dollar yen. The thing is as well, as you say, there's been 500 pips done since Tuesday, which is I mean roughly 3% or so. There's other factors at play, and okay, first of all, reading some bank strats and stuff, they seem to be gradually adding to yen longs. So they are probably the people who have been hitting dollar yen every time we see those upticks, right? That is one thing. So positions are getting increased in yen longs, and then there's two other things going on. And yesterday we had a bit of a setback in dollar yen. Okay, from a technical level, and I know some people in the room sold it around 144, but there's also been you know, Nippon Steel is trying to buy itself more into the US, and the Biden administration is trying to block the trade for now, and I do think that has played a bit of a role. And then overnight you had like two other speakers and two other pretty important ex-BOJers. To start with, Watanabe said that he sees the potential of two more rate hikes this year, where the market is not looking at it that way. And then we have the comeback of Kuroda-san, who said that they are still a long ways away from the neutral rate, and where the market expects the Bank of Japan to somewhere land around 1% with the hikes over time. He said that the neutral rate could be around or below, but could be actually as high as 1.5%. And I think some of the markets, and the market being very docile and wanting to be long yen, and not a lot of people standing in front of it right now, because you have the risk of the NFP, and you have the lower yields elsewhere globally. All yields have been coming down around Japan, which is the condition for Japanese yen to strengthen. So all of this has made this move that we've seen up to now. But you know, I do think that a lot can change if you get a report. Imagine that unemployment rate comes in at just 4.1%. You know, for whatever reason, you may be trading 145 again pretty quickly as well. Especially that people have been gradually increasing their long position. So there's been a few reasons, a few good reasons why all of this happened, but we have to take also into account the yen volatility. I mean, if you look at the options, they are still, the yen vols are extremely high. So 100 pips move now is not 100 pips move in dollar yen 6 months ago. You know. 100 pips move now. Yen really moves like an emerging market currency right now, and it does move 1-2% in a day. So be ready for it. Be careful what you do in the yen, and also be careful for saloon doors, especially if you imagine that we get a mildly negative report and people want to send dollar yen back down to 141.5, the low after we hit the highs. And all of a sudden, some people may find it a good level to start to take profits. You may end up at 143 or 143 and a half again as well. I mean, for choice, it's not my preferred trading instrument or currency over this particular set of data today, but it's of course something that I'm closely watching if the report would be really good or really bad, you know.
Yeah, no, exactly. And we haven't even touched on the carry trade. That's a big part of this as well. That's been going on in the yen for a while. And if the Fed are going to go chunkier cuts and the BOJ going to continue to hike, then that rate divergence is going to narrow further and make the carry trade less attractive. I don't. That was a great play by Blake getting in at 144s yesterday. Pretty much on the nail on the head with that one. I don't think a good number turns this around. That's what I meant at the beginning. This is more these moves and yields being bought up. Bonds being bought up, maybe locking in higher yields before Fed cuts really start. That's big flow moves, and they don't give that much. They don't give too much notice for data points. So if we get a big number, a big positive number from the NFP, I can see, a decent rally in the dollar, decent rally in the dollar yen, but I don't think it's going to change the picture. And that rally will probably get spanked at some point, and because the market isn't going to throw all its positioning out just on one data point. And if it's a bad one, it's just a green light to keep pushing it further. So I might be in the rally sell camp if we get a really big outsized move in this one. But like you, I'm probably going to I'm going to look elsewhere. James is asking what's going to be your NFP instrument of choice for this one.
Two, and that's going to be gold and cable if I only trade two. I may actually do euro dollar, but it's always I'm always trying to look at what do I want to trade on a good number and what do I want to trade on a bad number. Okay, and I think gold and cable, gold and cable are kind of my two pairs where I'll be looking to add two positions again if it's a bad number. And on the other side, I would like if it's really a surprisingly good number. I think euro dollar is probably the one to the other side, and dollar yen, but dollar yen will be too late. I think dollar Swiss may be a better one if it's a really good report. That goes for the one and the other side of things.
Yeah, no, that sounds good. I'm continuing to look at gold as well. I think there's a potential.
Gonna go, mate. If that number is a bit bad with geopolitics how they are still right now, I think it's really, really, really gonna go.
Yeah. So I think that's one to go. If I go a buy stop up there before the data or into the data, I'll probably keep it a bit smaller just in case we get a fake out break and a quick reverse and I get knocked out on my stop. I would prefer a break there when there's not data around because that would be a more tangible break in my opinion. But and also either a dip down to that support 2480s, 2470s. Again, you got to take the volatility into account. You might have to be prepared to wear a bit of a spike below before coming back, but you can always wait and see if it comes back into the range again before getting back in. And that I think is the way to play it. Pick your levels. Look at where the decent levels are, where we've come through other data points and whatever that we haven't managed to break it. Because if you don't break it, you can always then trade the range. So as much as I might be a bit bullish trading a break, if we bounce up here, get the NFP data and we can't get through, then it might be worth trying to short and just seeing if we play a retracement back down to the lower end of the range. Euro dollar, I'm keeping an eye on because obviously we've got the massive 112 up there, which did the job last time. We're probably maybe far enough away that it's going to put up a bit of a fight if we get up there again. But obviously, if the data's really stinky, then that's probably going to give the dollar another leg lower, again, there might be a chance of a break. So if I do look at having a little short up here, again, I might look to reverse that if we break that 112 area, get long for another leg higher on that as well. And Kate, I assume you're going to be bid in euro sterling 85.20 and offered at 85.35.
84.20 and 84.35. Yeah, it's a magnet in this euro sterling, right? Around 84.35. I think we just let it run and see where we go to next week, mate. There's
this is
really
not one
nothing
we'll
to
be
do.
trading over the
Huh?
NFP.
There's really nothing to do in euro sterling right now. I still think some are playing around with it because what was actually interesting again yesterday is that as soon as you get under 84.20, you do find bids, and then when we go up to here this zone 35.40, we find offers. So I think it's just 83, what is it, 83.90 or so, or psychologically already back below 84 or so, could see a bit of continuation. And then if we start to get back above 84.5, 84.60, then I don't think it's good to be short anymore. But for the rest, minor, it's actually a good carry trade. I think it's like 0.1 people, so something of the likes, which is in favor when we short euro sterling. So there's not a lot to grab there, but at least it doesn't cost any money to keep the position running for as long as it really doesn't move.
It'll buy you a small sherry at the end of the week, mate. Last one I'm probably going to keep my eye on, and then I'll bounce it over to Kay quickly, is going to be S&P, which is really getting down towards this big level that I've been banging on about for a while. This was a big level on the way up, big level after it broke, and we had a little bit of messing around there, but then after the next break up, it's held again. So this could be a bit of a make or breaker for stocks. We broke down through the support this week, 55, 55, 65. We held it as resistance. We've gone through all the other levels and started to hold them as resistance as well. So this level is a real doozy for me. So I'm going to keep an eye on that one. If we can't break that over the data, then that might be one that I'll try a bit of a dip buy. Right, mate. Sorry, I'm going to give it over to you for if you've got any others, mate.
Yeah, just a couple because I'm keeping an eye on. Oops, I'm keeping an eye on cable and perhaps the differentials. Just for those looking at those differentials, because you know that I always keep a very close eye on those. We are gradually ticking up due to the expectations and for what could happen on the Fed. Yeah, the expectations for this Fed and ECB upcoming next week as well. This jobs report is going to drag it around, and you can see we are on a bit of a level here in the 140, 150 BPs negative zone. If we get a real bad report this afternoon, this is probably going to break above those prior tightest differentials. So if this goes up, usually euro dollar is going up as well. If this goes down, it may weigh on the euro dollar inversely. Okay, so down means wider spreads, means tighter spreads and positive for euro dollar. Okay, so this is one which is going to be moving this afternoon for sure as well. And then let's look at the currencies. Yeah, I had gold on there as well. And I just wanted to highlight it. It's a little. Now I'm going to just zoom in first of all, where I think is going to be. So we've got, that is no surprise, at 24.30. But then above there we have a first, because when we are talking about all-time highs, we can't really do anything else than or put like some lines in there, which probably drive us also up to high 25s. But if you start to break above 25.30, you have to look at 25.5, which is a bit of an extension level. But above there, and whether it's shorter or longer term, I don't see much before 26.5. So be careful if this number is really bad, if the market continues to buy gold and prepare yourself for the Asian session if this would be the direction, because we know that the Asians are liking to buy gold if they can if they find a good reason for it. I don't have much before 26.5, so there may be if we break this afternoon and hold that 24.30, there may be $100 in there in gold. Okay. Inversely, if it's all going to go the other way around, as Ryan already mentioned, 70.80, and then we could be on our way to, for instance, 24.40, 24.30 before rethinking what to do. And then the other one that I'm really going to focus on today, there's actually a couple, is cable. Okay, so cable. You know, I'm long from here the other day at precisely there, 130.91. Let's let a decent bit go of it, and now I'm like just waiting for what to happen today. 132. If 132 starts to break again, of course you confirm through 132.25, but there is a fair chance that we are going to have a look again at the prior high. Next one up is around 133, 133.10. Okay. But if you look at it from a bit of a longer term perspective, and I also have it on the longer term, if this bullishness continues in the cable with that break here, ultimately we could be on our way to 134. So that is sort of my more medium-term scenario for as long as this zone holds. And this zone, I've divided it in two levels. So the first is the level where we held on Tuesday, and the second one is around here, around this prior high, 130.40 down to 130.20. That is my, call it, zone of no return, but that would be a danger zone if we went down there and don't start to rally up to rally again. This would be dangerous then for more downside. Okay, for the time being, I still view this as positive. And then two last little ones is EuroCAD. We seem to be building on it, and that's important for the Canadian jobs report today. Keep an eye on what's happening around, and we are not far away. 149.80, 149.50, 60, and then 149.20 if the jobs report is good or would be a little bit better. If we see a bit of a setback and then start to go higher again, that means the correction in Canada is probably done. Or if it's a bad report, look at 150.40, 50 on the EuroCAD. This could actually continue to move higher back into the 151s. And last one is the Sterling CAD going up and down for the time being. I'm also like, but it's really tiny, right? And if it goes back below 177.5, I'm probably gonna be out. But looking at how sterling behaves, the potential of Bank of England keeping rates still this month, also the data in the UK not falling out of bed. This is one also that I'm going to keep a very close eye on in case of a bad report, because then I think we can gradually move back up into the mid, and why not high 78s up to 179 in sterling CAD. Perhaps this is how I look at it. Get a good report. This probably time to move out. If it's a bad report, I'm looking to add to positions potentially. Back over to you, mate. And wishing everybody an absolutely stellar weekend, and be careful on the jobs report today. If you don't know what to do today, Monday, there is another week starting.
Yeah, thank you very much, mate. Wise advice as always. And yeah, that's it for us this week. Thank you very much for coming to the Flow Show, supporting us here. I hope we've steered you okay with our analysis and views and getting you ready to trade all these big events and get through markets unscathed. I hope you've had a good week. Don't spoil it if you have on gambling over one data point later on. As Kay says, you can always come back Monday. Markets will be here, touch wood, and we go again. Have a great weekend, everybody. See you all next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.